Okay, now we are going to discuss the accounting for the revenue grants. And I've already told you that the revenue grants is the grant which is other than the capital grant. Like capital grant is for the acquisition of the asset. Other than that, for example, if it is for, let's assume the wages and salaries, let's assume to continue the operations in the deprived area operations, let's assume to train any number of people over there and trainings, etc. Or to achieve a non-financial goal, it can be anything. Other than capital grant, it can be anything. So how to record the revenue grants within the financial statements? And we have already discussed the concept that once you receive a grant, it cannot be recorded directly in the profit and loss as an income. The reason behind that is that there are certain number of conditions attached to the grant, which is the reason we cannot record the grant directly in the statement of profit or loss. When you receive the grant, you debit the cash, but you record the liability, a corresponding liability. The reason is that you have to yet to comply, yet to comply with conditions. So when you are yet to comply with the conditions, you are going to record the grant as a liability at the first place. And then when systematically you are meeting the conditions, you will be de-recognizing the liability or systematically de-recognizing the liability and crediting the profit or loss. That means recording the grant as an income in the profit or loss. And this process in which you initially record the liability and then you systematically de-recognize it, this process is known as amortization of grant. So initially when you record the liability and then you de-recognize it systematically, this process is known as amortization of grant. Amortization of grant. Not amortization is not only related to IAS 38. It's a term we use to spread, in fact, the cost usually. But here, the amortization of grant means that when you are systematically de-recognizing your liability and recording it as an income in the statement of profit or loss. Let me do the example first, and then and then we will be discussing the last bullet, which is regarding the presentation of the revenue grant within the financial statement. So we have an example. A company is given 300,000 on 1st January 2001 to keep staff employed within a deprived area. So the company got a grant from the government of 300,000 on 1st January 2001, start of the year, to keep staff employed. Okay, fine. That means you have to keep them as an employee within your company for how many years? The company must not make redundancies. You cannot fire them for the next 3 years. That means you have to keep them within the company as an employee for the next 3 years. Okay, fine. So this condition is for 3 years, or the grant will need to be repaid. And the government says, if you're going to make any of them redundant, you have to return us the grant. Now, the government can say this thing because they are in an authoritative position. Now, how to initially record the grant? We know that we are going to debit the cash and credit the deferred income, which is the liability recorded. So at first place, you're going to make an account of the deferred income, which is the account of the liability, deferred income, and the opening balance is recorded on the credit side because it's a liability for 300,000. Now it is 31st December 2001, 1 year has gone. No redundancies have taken place, none are planned. So you didn't fire anyone and you're not having any plan to fire anyone. So that means you have complied with the condition of the first year. Now what you will be doing, systematically spread the grant over the period. So the total grant was 300,000. Spread it over 3 years. That means every year 100,000. Now when you have complied with the condition, de-recognize the liability of 100,000 and record that thing in the profit or loss as an income. So debit deferred income account. That means deferred income account has been debited due to the profit or loss. This goes to the profit or loss, and the closing balance is 200,000, which is going to be the opening balance of the next year. Now, this is as simple as you are looking, as you're watching. No rocket science in it. But there's one thing to understand that look, when we say IS1, IS1 is a presentation of the financial statements. And when we talk about the statement of financial position, liability section, it says that liability is of two types, the current liability and the non-current liability. The liability which the entity have to meet within 12 months is known as the current liability. The liability which is outside 12 months, more than 12 months, is recorded as a non-current liability. Now you see, at 31st December 20x1, or you can say 1st January, let's assume this is 1st January 20x2. Now at this date, the first liability you have to meet is within 12 months. That means for the year ended 31st December 20x2. The next portion of it is for 20x3, which is outside 12 months. So that means this 200,000 needs to be split between current and non-current liability. Look, that you got a grant, we have complied with the 1 year conditions. And if you say from the start of the year, we can do that. Like when we got a grant, we have to record this thing as a liability. This 300,000 should be recorded as a liability. How we should record is as a liability. You can say the first liability was within 12 months. Within 12 months and outside 12 months. So within 12 months was the first year. Now 100,000 should have been recorded in the current liability. The 200,000 should have been recorded in the non-current liabilities. This was current and this is non-current at the start when you receive the grant. Now we are done with the year one and we are only left with the 200,000, which is in the liability. Now, one liability relates to the coming 12 months that should have been recorded as a current liability. And outside that is another 100,000 that should be recorded as a non-current liability. And this is the liability which belongs to the year three. So this is important to understand that this 200,000 is going to be split between the current and non-current. Okay, now we'll be discussing the presentation of the revenue grant in the statement of profit or loss, the income statement, which is the, you can say, obsolete name of the statement of profit or loss. So it's the statement of profit or loss actually. So in the statement of profit or loss, you have to record this revenue grant as an income. There are two ways of presenting this grant within the statement of profit or loss. The first method is to present as a separate item of income. Now, what is this? Present as a separate item of income. And the second method is deducted from the related expense, which is then shown net. I give you the example over here. And I said you that the grant is 300,000, which you're getting from the government. And you have to employ those people which the government has set in their conditions. When you're employing those people, obviously you have to give them the wages and salaries. So the relevant expense is the wage, for example, wages and salaries, which you will be paying, which you will be incurring. And as a result, you will be getting the grant, which is an income for the company. Now, this is the amount of the grant which you're getting from the government. And this is the amount which you are paying to the employees in terms of wages and salaries. Now, there are two methods. The first method is present it as a separate income, like record the income and expenses separately as a separate head in the statement of profit or loss. Record income separate, expense separate. Or the second method is deduct the related expense, which is then shown net. Net of these two things. When you're going to net off these two things, either it is going to be net income or net expense. So there are two methods of presenting. Let me summarize it. Either you can record the grant income and expense separately within the statement of profit or loss, or you can just net it off. Now, netting off means either it is going to be the net income or net expense within the statement of profit or loss.